Hi, welcome to my video. This is chapter 2 for your financial accounting tool. So this topic we want to discuss the changes in the ownership when in a partnership. So what you can learn from this chapter, so after completion of this chapter, you should be able to understand the reason of changes in the ownership in a partnership and what is the corresponding accounting treatment when you have a changes in the ownership in a partnership. So let's start. The reason of changes in the partnership ownership. The first one, emission of new partner due to expansion. So sometimes when your partnership want to expand, you may get new investor. You may get new investor to join the company. So the new investor will become the new partner. So the ownership percentage will change after the new owner is joining. I can give you some illustration. So for example, you have a partnership, let's say Mr. A and Mr. B. So originally Mr. A and Mr. B share the profit or loss equally, and after the emission of new partner, let's say Mr. C, the percentage may change to 33% for each. So emission of new partner will definitely change the ownership percentage in a partnership. Next, withdrawal of existing partner. Let's say after a year, Mr. B want to go for retired, and the profit and loss structure may change to A and C based on 50 and 50. Withdrawal of existing partner. Let's say B don't want to join the partnership anymore. So the ownership will change accordingly. And last one, change in the ownership among the existing partner. For example, A and C, they want to expand the business. So as C can put in more money in the partnership, but A say that I got no money anymore. So based on the new capital injection, the percentage may change like this. Change in the percentage or the ownership among the existing partner. This should be C. So these three are the possible reasons. The first one, emission of new partner. Second one, withdrawal of existing partner. And third one, change in the percentage of ownership among the existing partner. So these are the three possible reasons of changes in the ownership. So when you have a changes in the ownership, what you have to do? You have to fair value the partnership. So how to fair value the partnership? Step 1, you have to fair value what? The asset and liability in the partnership. On the date of change in the ownership, a partnership may adjust its asset and liability to its fair value. Fair value can be considered as the market price or realizable value. It means that what is the current selling price. Reason of fair value asset and liability is because its book value. What is book value? The amount recorded in the account may be different with its market value or realizable value. A valuation account will be created to adjust the book value amount of asset and liability to its fair value. Any gain or loss arising from the fair value will be shared to existing partners' capital account based on the original profit or loss sharing ratio. Take note, when you have changes in the ownership, you have to create a revaluation account. So if you have revaluation account, definitely you will have gain or loss arising from the fair value adjustment. And this fair value gain or loss from the fair value adjustment only share to existing partner. The new partner cannot enjoy this gain or loss. And how you share? You base on the original profit or loss sharing ratio. So we can use one example to understand the concept of revaluation. So classroom exercise 2.1. Mr. A and B are having a partnership called Shining Enterprise, who's sharing profit or loss on the basis of 3 to 2. So 3 to 2 means A can get 3 portion and B can get 2 portion. On 1st January 2018, Mr. C has joined the partnership as a new partner. So we know that Mr. C is the new partner, and the new profit sharing ratio will change to 3 to 1. So Mr. A is still getting 3, B is 2, and C get 1 portion. So below is the book value and fair value of the asset and liabilities on the emission date. So from here we can see these are the asset and liability of the company. So the first one up to the fourth one, this is the asset of the company, and this is the liability of the company. And we can see that this is the book value. Book value is the amount that we record in the account. Fair value, we can refer to the market price. So when there is a changes in the ownership, we have to do revaluation. So the revaluation will based on the market price of the asset and liability. So now we have to identify whether the asset value increase or decrease. So first one, land. The book value of the land is 120,000 and the fair value is 150,000. So the value of land become higher or lower? The value of land become higher by 30,000. Next, office equipment. Office equipment is asset of the company, and the book value is 38,000. The market value, fair value is 30,000. So the value of the asset become higher or lower? The value of office equipment become lower by 8,000. Next one, inventory. Inventory is the asset of the company. Inventory, the book value is 65 and the fair value is 62. So the fair value is higher or lower than the book value? The fair value is lower by 3,000. Next one, trade receivables. Trade receivables on the book value is 76,000 and on the fair value is 71,000. So we know that the fair value of the trade receivables is reduced by 5,000. Next one, trade payables. 59,000 on the book value and 57,000 on the fair value. So we know that this is also decreased by 2,000, and trade payables is your liability. So the requirement, we have to prepare a revaluation account to reflect the changes in the fair value of Shining Enterprise. So to have a better presentation, I will key in the data in an Excel file. So let's record the first one, land. The land value increased by 30,000. So what is the entry in your revaluation account? Debit or credit? The answer is credit. Take note, we only record the changes, the difference in the revaluation. I can show you an example. Why increase in the land value 30,000 is recorded in the revaluation account on the credit side. So let's draw revaluation account. Let's draw a land account. So this is land account. We know that land account is an asset. So the opening balances is on the debit side, 120,000. So based on the fair value, the correct fair value of the land is 150,000. So how we increase the value of land? We have to debit the land account or credit the land account. The answer is we have to debit the land account, because land is asset. In order to increase the asset value, we debit the different amount, 30,000. So by posting this entry, the final value for your land will change to 150,000. By posting this entry, your land will change to 150,000 at the end of the fair value. So we debit the land account and credit in the revaluation account. Next, office equipment. Office equipment from 38 to 30, it means that decreased by 8,000. So we can draw a ledger to understand what is the correct entry in the revaluation account. So this is office equipment account. The opening balances is 38,000 because it's asset, so the brought down amount is on the debit side. So we know that the value decreased by 6,000. So we record a revaluation here, 8,000, and the adjusted balance CD become 30,000. So it means that by posting a credit entry on the office equipment account, the office equipment account will reduce to 30,000. So we credit on the office equipment account, so we have to debit on the revaluation account. Again, please take note, you only record the difference in your fair value and book value, 8,000. Next, the next one is inventory from 65,000 to 62, decreased by 3,000. So this will be very similar to your office equipment. So inventory decreased by 3,000. Next, trade receivables. Trade receivables from 76 to 71, decreased by 5,000. So the treatment will be similar to your inventory, because decrease in the asset value we record on the debit side of your revaluation account, 5,000. And last one is your trade payables. Trade payables from 59 to 57. We can draw a ledger to understand what is the entry in the revaluation account. So this is trade payables account. For the trade payables account, the opening balances is on the credit side because this is a liability, 59,000. So we know that the fair value is 57,000. It means that decrease. In order to decrease your trade payables amount, you have to debit the trade payables account, so that the adjusted balances will change to 57,000. By posting a debit entry in your trade payables account, your revised trade payables will become 57,000. So we debit the trade payables account on the revaluation account will become credit, and the amount is 2,000. So up to here we have posted all the fair value adjustment, and after you posted all the fair value adjustment, the next step is to identify whether you have a gain on revaluation or loss on revaluation. So from this comparison, we know that the credit side is higher than the debit side, 32, and this is 16,000. So we know that the balancing entry will be on the debit side, so this is a gain on revaluation, and this gain on revaluation will share to A and B only. Why? Let's come back to the textbook. Any gain or loss arising from the fair value will be shared to assisting partner only, okay, and based on the original profit or loss. So tell me, how much is the profit from the revaluation? 32 minus 16, so the gain is 16,000. So how we share the 16,000 to A and B? We can do a working. So the gain on revaluation is 16,000, and now we have to do a working to share the 16,000. So we have two partner, A and B. C is not entitled because C is the new partner. A can get 3 portion, B can get 2 portion. It means that the total portion is 5. So we divided by 5 times 16,000. 3 divided by 5 times 16,000, 9,600. And for B is 6,400. So the total amount is 16,000. Mr. A can get 9,600 and Mr. B can get 6,400 from the gain on revaluation. So let's record this in the revaluation account. 9,006 and 6,004. So by posting the gain on revaluation, we can balance the revaluation account. So we have complete the 2.1 exercise. Next, before that, let me highlight something to you. For revaluation account, if you have increase in the asset, you record on the credit side. When you have decrease in your liability, you also record on the credit side. So as an opposite, when you have decrease in your asset value, you record on the debit side. When you have increase in your liability, you record on the debit side. Basically, this is the loss. This will be the gain. And for the balancing amount, gain on revaluation will appear on your credit side because your credit side is higher than your debit side. So this will be your gain on revaluation. And for the loss on revaluation, this will appear on the credit side of your revaluation account. I repeat, when you have increase in asset value or decrease in your liability, you record on the credit side. When you have decrease in the asset value or increase in the liability, you record on the debit side. The balancing amount, if appear on the debit side, gain. If appear on the credit side, will be the loss. So this is your step 1. identify the fair value changes and identify the gain or loss from the revaluation. Next, step 2, you have to recognize the gain or loss of your revaluation to the partner's capital account. After the completion of revaluation account, we can determine a gain when your fair value is more than your book value, or loss if your fair value is lesser than the book value, arising from the fair value of assets and liabilities. Any gain or loss from the revaluation will be transferred to existing partners' capital account based on their original profit or loss sharing ratio. So please take note, any gain or loss arising from your revaluation only share to existing partner. And how to share? Based on the original profit or loss sharing ratio. So let's try this exercise. Classroom exercise 2.2. From 1st January 2018 trial balance, it shows that the capital account by A and B is 300,000 and 200,000 respectively. It is agreed that Mr. C will bring in 100,000 as the capital of emission. Continue from classroom exercise 2.1. Please prepare the partner's capital account after the emission by Mr. C. So again, for better presentation purpose, I will use Excel account to present the capital account. So the format will be very similar to your textbook. So this is your capital account. So first one, we have to record the opening balances of the existing partner. The opening balances we record on the credit side because capital is equity. Equity is on the credit side. So 300,000, 200,000 for B, and 0 for C. And Mr. C is joining by using 100,000 capital, right? So we assume this joining is paid by bank. So this is to show the emission. And don't forget about our gain on revaluation. Gain on revaluation we record on the credit side. Why? Because this is on the debit on the revaluation account, and then credit to the capital account. So 9,600, 6,400, and 0. Because C is the new partner, so C is not entitled for any gain on your revaluation. Because though gain, C is not contribute anything. That's why every gain or loss shall share to the existing partner first. So we can total the amount. So we have a balance CD. So that's all for the capital account. So let's stop a while here, and we will continue part 2 later. Thanks for watching.